Bank of Canada has delivered a jumbo-sized rate cut, says more cuts likely on the way. It aims to stick the landing on inflation. Joining us now to discuss is Andrew Kelvin, head of Canadian and Global Rate Strategy with TD Securities. Andrew, always great to have you in the program, particularly on a day like this when we get a jumbo-sized rate cut from our central bank. What's your take on it?
Yeah, thank you for having me. It's not boring, so that's good. It was an interesting decision, not so much the decision itself to move by 50 basis points. The market had pretty much fully priced that in, so we weren't especially surprised to see that, though I will make the argument that 25 basis points was probably a more appropriate move in our view. Nonetheless, they gave the market what it expected, what it wanted. I think what I was really surprised by was how little they had changed their story relative to September. The revisions to their growth forecasts were actually pretty minimal, which just sort of didn't especially fit with this idea that they needed to speed up the pace of easing. So we're sort of left trying to reconcile their decision to move by 50 basis points today, whereas they were comfortable with 25 basis point increment cuts in September. And we can kind of fit a few different stories to the narrative. Partly, I do think that they were very likely always moving in this direction. They just perhaps felt that they hadn't provided sufficient cover to the markets at the time of the September meeting to make that decision. Because if you take them at face value, their comments in September at face value, they said if things get worse, we will speed up the pace of rate cuts. Things have not gotten worse between September and October.
They haven't really changed.
They haven't really changed their forecast very much. So it's sort of hard to look at that explanation and justify today's moves. Okay, so what do we look at? Are they just chasing the markets? Did they not want to disappoint the markets? Again, no one's ever going to admit to that. They do have a pretty decent history of surprising the market. So whereas market pricing perhaps could weigh on their thought process of the margin, it's not like the Fed where market surprises are exceedingly rare. The Bank of Canada will surprise. So I don't know if you can put that forward as the most likely explanation. What it comes to for me is that you had a split in governing council where there were some individuals who needed a bit more time to be sure that inflation was likely to be moderating. Perhaps the Bank of Canada Business Outlook surveys, which showed a little bit of a moderation in inflation expectations, proved decisive, much more so than that last CPI print, because that was on oil and airfares. That stuff's volatile. Changing your rate path on that single CPI print would be irresponsible. I think what it comes down to is, given that they don't have an extremely negative path for growth, given that they don't have a disinflationary path for core inflation metrics, they're probably rushing just to get to sort of the neutral range where they think they're no longer being restrictive on the economy. They've said they're going to be data dependent, so they're not going to pre-signal any moves, and honestly that's the right thing to do. If you keep someone like me guessing, that's a small price to pay for giving yourself flexibility in how you follow that policy path. But I think what it really comes down to is the Bank of Canada no longer believes it's appropriate to be in restrictive territory. They're going to get out of it as quickly as possible, and where they end is now the real question.
If they do want to get it as quickly as possible, and of course this question was put to Tiff Malcolm numerous times during the press conference after the decision about how aggressive they would be going forward. At the next meeting after that, more 50 basis points. They won't commit to anything, but if they really want to get back to neutral fast, could we get another 50?
That is our base case here, that we get another 50 basis point cut in December. December's priced sort of as a coin toss, which is appropriate at this point. Given the way market pricing moved around the most recent jobs prints and the most recent CPI print, market pricing is going to be extremely volatile. Like, I would be surprised if over the next month and a half, we don't see news stories talking about market participants looking for a 25 basis point cut, followed very shortly by stories about market participants looking for 50 basis point cuts. It's going to remain volatile. But I think what I really come down to, at the end of the day, accelerating the pace of easing just one time and moving back to 25 basis point cuts, you're not doing very much to change financial conditions there. You're not doing very much to change economic outcomes. If I assume they have a plan here, and it's usually a good bet that they have a plan, it makes sense that you would follow that up with another 50 basis point move unless the world changes dramatically between now and December, which for reasons that I'm sure we'll discuss later, I mean, it could, I suppose, but.
Of course, ahead of any rate decision, we always sit around the desk in the morning. You're waiting for the decision to arrive. It's like, so if it's only a quarter, what's the justification here? We're saying, well, is it just that stronger than expected jobs number that we got? But it was interesting when I was going through the thing. They didn't seem all that impressed by the labor market. Jobs, layoffs have remained modest. Business hiring has been weak, affecting young people, newcomers. They didn't seem that impressed.
So with the strong population growth that we've seen over particularly the last year, but over the last few years, what we think of as the break-even pace of employment growth, it's increased dramatically. Now you need to be seeing 50, 60,000 jobs per month to hold the employment to population ratio stable. One thing Governor Macklem did really seize upon in his comments today is that a lot of that increase in unemployment, it's been concentrated amongst newcomers and students, which are the parts of the economy where you expect labor market stresses to show up first. So what they're focused on, it's not job changes so much as it is the move in the unemployment rate. And I think it raises a really interesting question though, because in terms of your impact on growth and inflation, having localized but high unemployment rates amongst lower spending cohorts should be less disinflationary than a broad-based increase in unemployment. Because if the unemployment rate had increased by the same amount amongst all cohorts of the labor force, you'd expect a far more disinflationary outcome than one that's just concentrated amongst newcomers and amongst young people. So but that is what he was seizing on. There is some element to this where if you have cut the overnight rate by 50 basis points, you do need to have a reason for it. It did feel a little bit like
we felt like it. Yeah,
yeah,
that won't be good enough.
Yeah, I woke up, looked at the sun, it was a 50 sort of a day. It did have a bit of a tinge of an ex post justification to it.
That's the labor side of it. Well, let's get back to the inflation side because they say we need to stick the landing on this. The biggest downside risk, they said, is that it takes longer for household spending and business investment to pick up. I think there was something in the opening comments or maybe the Q&A where they said, we think we give the country 50 basis points, we're going to see that pick up. But if it doesn't, maybe they got another problem on their hands in terms of inflation being too low.
So this really comes to the conversation around the terminal rate. Not to belabor the point, but that same statement could have equally applied in September, which is why, again, October being the month that convinces you to move by 50 basis points was a little bit curious. Actually, it was probably more strongly applied in September. They see slack in the economy. Their way of thinking is that slack in the economy is the thing that generates inflation in the future. So if you have no slack, or if you have no slack in the economy, you're much more likely to see high inflation in the future than if there's a lot of slack in the economy. So they believe there's slack in the economy. The way you achieve 2% inflation, not 1.5 or 1, is you reduce that slack to 0 over time. It's why, although the Bank of Canada is an inflation targeter, they do have concerns around things like the labor market, not because they have a dual mandate like the US does, but because those things feed into their inflation path. If moving quickly to the sort of neutral area is not going to be enough to cause growth to pick up, we wind up in a world where slack is potentially persistent, and then you need to provide even more stimulus to cause businesses and consumers to increase spending to the point that they would see as consistent with 2% inflation. So what this comes to is, do you think that you will be able to achieve your 2% inflation target just by getting to 3 or 2.75 or something in the sort of neutral range? Or do you need to go more firmly into accommodative territory? But not pre-committing. I would suggest after today, given those evident concerns, the risks of them moving into accommodative territory. And when I say risks, I don't mean inherently that's a bad thing. History will tell us if it was necessary or not. But it's a much greater probability that they will need to move below their neutral rate into sort of the low 2s, just given those evident concerns.